quant fund at its core is a systematic approach to portfolio management where data is the key driver of a stock selection process. So one can almost think about it in terms of parallels vis-a-vis, let's say, an automatic transmission and a manual transmission in a car. An automatic transmission, what it does is it takes the same data points that a driver would use in making the decision whether to change the gear or not, for instance, speed, etc. But it just automates that process. Initially, there was skepticism around that process, but increasingly riders prefer an automatic transmission because for the comfort it offers. But at the end of the day, the aim is to use the same data points to help make that decision. So similarly, a quant process at the end of the day uses a lot of data, different types of data at a stock level. And also what it does is it has a lot of fundamental drivers of stock returns. So to that extent, it is just trying to do the same job, but using data as the critical input, which will drive your stock selection decisions, right? The key differentiator here is the fact that it has a non-biased approach to portfolio management. If I were to highlight 3 points about quant investing, first is that unlike popular perception, quant processes can be transparent. So one can get an insight into what are the data points or what are the data sources that are being used and how's the model structured. Second is that different types of data are used. For instance, historical data is used for analyzing certain parameters. We use concurrent data, which is price and volume data, to understand what the market is thinking about a stock. And lastly, we are using growth-related data, which is forward-looking data. And the third most important point is, being a systematic rules-based process, it essentially reduces human biases by making sure that portfolio manager interventions are restricted to a very minimal level. So those, I think, are the key defining points of a quant fund. Quant funds and in general, most of the quant funds, and ours in particular, is a completely active offering. There are a few passive offerings in the quant space, but that is more smart beta kind of strategies. So if we leave aside those for a moment, then there is a very compelling reason to have quant offering as one of the products in the basket. And the biggest reason is diversification. So just like you wouldn't invest all your funds, all your money in, let's say, one sector, even though IT sector has given you returns over the last 10, 12 years, you wouldn't put all your money into IT sector. You would diversify across sectors. Similarly, there is value to diversifying across different types of funds. What it does is it makes your portfolio a lot more robust, and your experience through the cycle will be much better with a diversified portfolio of funds rather than having similar kind of strategies. And the diversification largely comes from the fact that the process of stock selection and portfolio construction in a quantitative approach is quite different to a traditional methodology. And that, I think, is the most compelling reason to have quant as one of the product offerings in your suite of products. So from a client perspective, look, when it comes to evaluating funds, be it a quant fund or any other fund for that matter, it is just a case of opportunity cost of capital. So I think when a client looks at it, for them, it is a case of whether they should put in, let's say, a quant fund or, let's say, a flexi cap fund. And from that perspective, they should not treat quant as a special category. They should just look at it as the way they would look at other funds. But the most important thing is they should evaluate the fund over a longer term point of view. And when I say longer term horizon, I mean 3 to 5 years. And that applies for any fund for that matter, because at the end of the day, it is all about a cycle. If you evaluate funds over a shorter period of time, then the danger is that you exit it too early, or in worst case, you lock in your losses, which is the worst thing to do. So be it quant fund or any other fund, as far as a client is concerned, I think they should look over a longer term horizon. And by longer term, I mean 3 to 5 years. So the first thing to note is that every quant fund, like other traditional fund, will always have a certain tilt to a particular style. And that depends on how the model is designed, and that depends on the fund house itself. So you can have portfolios that are purely momentum, like you have a couple of products out there within the quant space that are purely momentum. And you can also have products that are value focused, that are quality focused, or you can have a product that is a combination of these styles, which is what we are. Our focus is what we call as a QGAR, which is a portfolio, investing in a portfolio of quality stocks with good growth at reasonable prices. So we are a combination of these styles. So the first thing that any MFD has to do is understand what is the kind of style tilt that you're getting with the portfolio. Second thing to analyze is what is the portfolio, how is the portfolio construction process, and how is risk looked at from a stock level, from a sector level, and also look at the beta and the volatility of the fund, like you would look at the beta and the volatility of traditional funds. So there are some parameters that you would use to evaluate a fundamental fund would also apply to this category. So you're looking at risk from a stock level perspective, concentration perspective, looking at sector risk, looking at portfolio beta, looking at volatility of the stocks. Those things would apply to this category as much as it applies to some of the other categories. The other thing to look at is basically, as with any category, discipline is the key. So the other thing to look at is to see when can the portfolio manager intervene, when will there be manual interventions, to what extent will there be a manual intervention, and how frequent it has been over the history. That also helps you decide whether a quant process is run in its true nature, or is there modifications to it. So I think these are the few things that an MFD would have to look at while assessing the fund. The rest, in terms of tracking ongoing performance and sector allocations, those would apply to this sector as it would apply to this fund as it would apply to other categories. Our fund, which is Axis Quant Fund, which actually end of last month just completed 2 years since inception. We had an NFO in July of 2021, and over that period, actually we've done well through the cycle, where we are in, even if you were to compare us across a broader category, for instance, let's take FlexiCap as an example, then even within that category, we are beating the median returns on a FlexiCap category comfortably over a 2-year period. We are in fact in early Q2, and over the last 1 year, on a rolling 1-year basis, we are Q1. Q1, if you look at on a 1-year trailing basis. This data is as of the end of last month, and needless to say, that's pure historic data, so one needs to look at everything in context when considering these data points. But we've been able to hold our own and kind of deliver returns and match other categories through this cycle. So Axis Quant Fund, as I've briefly touched on before, is basically aims to invest in what we call as QGAR, it is a portfolio of quality stocks with good growth at reasonable prices. So we aim to invest across styles. So think about it almost as we are diversifying across sectors. When you're diversifying across sectors, you get a much smoother ride over a cycle. So when you're diversifying across styles, you get periods when value works, when value doesn't work, growth works, growth doesn't work. But over a cycle, or when you're investing across style, you should do well across that cycle. And that is what we are doing by investing across styles. Second thing, we just don't focus on returns. So any stock that ranks well on our model, we just don't take that and make it the largest position in our book. What we do is we also take into account parameters on the risk side. So we look at what is the risk of the stock, what is the liquidity of that stock, and there are limits at a stock level, there are limits at a sector level, and we also make sure that the portfolio liquidity is within a certain defined range. All this means that our portfolio beta over the last 2 years has consistently been less than 1, which means the investor is getting much better return when adjusted for that risk. So those are the things that essentially set us apart from some of the other quant offerings in there. If you look at a broader category like flexi cap, for instance, there are a lot of funds with which hold stocks at around 40, 45 numbers. So it's not an outlier by that means. The other thing to note is that in a quantitative process, breadth is not a weakness. Breadth is a strength. By breadth, I mean the number of stocks in your portfolio. That is not a weakness. With a traditional manager, the traditional managers knows a stock in and out. So what they want to do is they want to concentrate in the stocks that they like the most, and they like that concentration, and that is their strength. Whereas in case of in case of a quantitative manager, they are investing in styles, which is why they want to diversify across stocks, and that is where they get their strength from. And so it is not a weakness; it is actually a strength. Traditionally, within Axis Quant Fund, we've not targeted any cap allocation. So by that I mean there is no aim that we want to stay invested X% in large cap, Y% mid cap. That's not the aim. What we do is we size the positions in the portfolio based on the liquidity of the stock. So by that I mean higher the liquidity of the stock, larger will be the size of the stock in the portfolio, all else being equal. Now, what that has meant is over the last 2 years, we have an allocation to large cap that is roughly ranged between 50 to 75%. Mid cap allocation has typically ranged between 10 to 30%, and small cap allocation has ranged between 0 to 10%. So in a sense, these allocations have a broad range that we work around, and this range is very similar to what you would find in, let's say, a flexi category in terms of just the cap allocation. The allocation today more represents the opportunity space in large caps than over mid caps and small caps. It's just telling you that the model actually sees much more opportunities of stock selection within large cap than it sees in mid cap and small cap. And that is why you are seeing large cap allocation at the higher end of the historic range.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.